Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The real key consideration is not to let all the excitement, all the rhetoric, all the noise coming out of the election truly dictate investment decision-making, because everything we do is driven by the historical empirical data and academic research. And all of it says is that the rhetoric is oftentimes the exact opposite of what occurs. So don't let the noise, the rhetoric drive things. Focus on what you can control.
I think President-elect Trump is stepping into a very good situation. The labor market is at full employment right now. The unemployment rate is just around 4%. We're continuing to add jobs at a good pace. Wages are going up more quickly than inflation, and we are seeing inflation slow.
60% tariffs on products coming out of China would be a material negative for Home Depot and most retailers that import a lot of the merchandise. We estimate about 40% of the merchandise that Home Depot imports or sells is imported, which would lead to a significant increase in cost for them and likely prices for the consumer.
We got 1 hour to go until the market close, so let's take a look at the major averages. And Josh, it is not even 1 week since the results of the presidential election, and it feels like things are still percolating through. We just heard a few examples of the kinds of discussions that people are still having as they try to puzzle through what is the effect going to be, both on the economy writ large, on inflation, but also on individual stocks and sectors. So that's kind of like the backdrop for where we are today. And things are mixed today. We've got the Dow Jones Industrial up about 319 points or so, 0.7%. The S&P very little changed, and tech is actually coming under some pressure today, down about 0.1%.
You find yourself in this interesting moment, Julie, because you have two events that have come and gone at this point. So you have the election, of course. You had the November Fed decision. So now maybe you're kind of also wondering if you're an investor, what's coming next. I mean, you do have, the backdrop here is still an economy that's resilient. It's a consumer that's been hanging in there. Earnings growth has been decent. You do have some economic data on deck this week, which is important. We got CPI. And speaking of that consumer, we got retail sales.
Yes, exactly. So there are some things for people to look ahead to. I want to point out the outperformance of the Russell 2000 once again today, trading at its highest since 2021. And we've seen this resurgence in bullishness surrounding the Russell following the election. So that's something to keep an eye on. But really, the market mover to rule them all, so to speak, has been Bitcoin, and just the incredible surge that we have seen up above 86,000. I mean, every time you check the price today, it's like leapt another, a huge amount. So this is where we are right now.
We had some, different variables, but one clearly is we had some, candidates who position themselves as pro-crypto, crypto-friendly, who won, including, of course, President-elect Trump.
Right, but you had that initial move, and then it just keeps sort of feeding on itself. And of course, there is the ripple effect throughout the crypto stocks, which are also flying today. We're going to talk about MicroStrategy a little bit later, but buying more Bitcoin, it just revealed in a filing. But anything having to do with that universe has been trading higher. But it's also a little bit memey today, I have to say, as well. Stocks that have sort of gotten the meme label.
Old GameStop, look at that move.
Good old GameStop is up another 12% in today's session. So we're seeing a little bit of that action, that flavor kind of coming in today's session also.
All right, let's get more on this. The Dow building on its post-election rally as the S&P 500 nears a close of 6,000. Both indexes coming off their best week of the year with the Trump trade taking center stage. Our next guest growing more optimistic on the S&P 500, seeing a year-end target now of 7,000 for 2025. Yardeni Research President Ed Yardeni joins us now to discuss. Ed, is always good to have you on the show. So 7,000 for year-end 2025. Dr. Ed, what gives you that optimism? What gives you that confidence?
Well, I think we're seeing a emergence of animal spirits. It's very reminiscent of what we saw during Trump 1.0, when the stock market improved quite significantly when Trump got elected. And in addition, a lot of sentiment indicators really took off, like business optimism and consumer confidence also did extremely well. So I think we're just seeing a more pro-business administration coming in that's undoubtedly will cut taxes, and not only for corporations, but also for individuals. Lots of various kinds of tax cuts have been discussed. And in addition to that, a lot of deregulation. So we're upping our estimates for what profit margin is going to be doing over the next couple of years. It's going to go higher. And that's leading us to conclude that earnings are going to be stronger than we had thought and drive the market up to probably 7,000 by the end of next year, as you said.
Ed, are there any variables, though, that you're more worried about with a Trump presidency? You know, there has been, of course, talk on the part of economists that if you do get a trade war, that could be inflationary, deportations could be. How much do you worry about that?
Well, I worry about all those things. It's just a matter of giving weight to the worries. I mean, we all have the same information. And the good news in terms of what we can expect from Trump 2.0 is that there will be tax cuts, there'll be deregulation. And oh, by the way, I think there might be some diminishing in geopolitical crises, particularly in the Middle East and between Ukraine and Russia, if Trump is successful in cooling off those terrible wars. So all that is good. On the other side, we've got tariffs that could be inflationary, could lead to trade wars. But I think to a large extent, Trump is, playing the art of the deal, trying to get set for pushing a lot of our trading partners to be more accommodating in their relationship and trade, less kind of leaving us with the short end of the stick. So I think it's a negotiating position to a large extent. I think deportation is going to be handled slowly. I don't think it's going to be mass deportation. I think it's going to start out with the really bad actors, and then we'll see where it goes from there. But I think there's going to be a lot of pushback for employers who are finding that immigrants have fit into their production and services. So I think, there's pluses and minuses, but I think on balance, the pluses weigh out the minuses.
Can I ask you, Ed, generally speaking, if investors seem like right now, they're not really worried about anything, is that actually a source of worry?
Yes, to a certain extent. I do have a sort of contrary streak, and I think you're right about that. But look, what causes bear markets is recessions, and recessions are typically caused by credit crunches, caused by tightening of monetary policy. For the past 3 years, we've been in this terrible recession that never happened. It was the Godot recession. It was the most widely anticipated recession of all times. And it made sense. I mean, the Fed raised the Fed funds rate from 0 to 5.25%. Surely we should have gotten a recession. I didn't think so, but that was the widespread view. And if we couldn't get a recession out of what just happened with the Fed for the past 3 years, now that the Fed is easing, why are we going to have a recession? Other than perhaps a geopolitical crisis leads to an oil spike. But even that hasn't happened. We've had geopolitical crisis and the price of oil's gone down. So I think the prospect is that I think investors are starting to feel comfortable that there might not be a recession over the rest of the decade. I'm not saying we'll never have a recession again, but that very thought means that higher valuation multiples today may very well be grown out of as earnings continue to increase.
That's really interesting, Ed, and you took me exactly where I was going to take you, which is to the valuations chart that was in your note today, where you make note of the fact that we've seen valuations go higher for every different group, whether it's small caps all the way up to the ultra mega caps, although obviously the mega caps are the most highly valued. So how do you think about that? In other words, what you're saying is you think because the E is going to come up, we're not necessarily going to see an explosion of PEs from here.
Exactly. Yes. Not only do I think that earnings are going to continue to grow, but I think they're going to grow maybe faster for longer without a recession. So again, that means that over time, if the price were to stay here with a high PE, the E would grow and the PE would come down. I agree. Valuation multiples are in fact stretched, but I think they are consistent with the view that the economy is going to continue to grow. When you look at that chart that we just looked at, obviously the market is focusing on the mid caps, the small and mid-size S&P 500 companies, the 600 and the 400, because those valuation multiples have been down and out for a while. So they're catching up.
Ed, one final question. This country's fiscal challenges, not an issue that either candidate really wanted to meaningfully address.
Correct.
How, for long-term investors who are watching this right now, Ed, how should they be thinking about that?
Well, I think actually Trump has addressed it by appointing Elon Musk to work on cutting government spending. Musk does a great job of that in his companies. There's a great biography that came out a couple of years ago about Elon Musk, and he's a real cost cutter. Question is whether you can do it in the government. It's one thing to tell people that work for you that they've got to cut costs, and if they don't, you fire them. It's a whole different story, perhaps in the government. So we'll see how that plays out. But there's certainly an understanding that government spending, at least the pace of increase, has to be slowed. The question, of course, is revenues. And I think we're kind of back to the old Reaganomics idea that if the economy grows better than expected, that's going to grow revenues better than expected. And I think there's something to it. Even before Trump got elected, I think we were seeing productivity growth really improve. And I think the prospect is that economic growth is going to solve some of the problem. But at the end of the day, we probably still need a political solution. We still need a grand compromise to slow the pace of spending and to increase the revenues that are available. And I think, the Republicans have screwed up this opportunity before where they were in charge. Let's see if they get it right this time.
And I just wanted to drill down on one part of what you were talking about there, which is the Elon Musk factor. Sure. As an avid X user at one time or another, we know he cut a lot there as well. And the thing doesn't always work too well, seemingly as a result of that at various times. The stakes, one could argue, might be higher in certain parts of the government than they are with people posting on a social media platform. So,
right.
I've heard a lot of people talk about this idea of the Musk effect on government, that it would be a good, right, a positive. Mm-hmm. But what about the risks there?
Well, look, if we're talking about Elon Musk having more influence in the public sector as opposed to the private sector, or just more influence on what this administration does, clearly he doesn't always get things right, and sometimes he promises things that he can't deliver. So that may be an issue with regards to the spending cuts. But look, I think he's bought some time here in terms of a potential debt crisis. The bond market isn't going to know exactly where this deficit situation is going to go for a while. And I think it's conceivable that the bond market will give this administration the benefit of the doubt and assume that they will do something about cutting spending and that they will do something about finding sources of revenues. And maybe it'll be growth, but clearly Trump is talking about using tariffs as a source of revenues, at least that 10% tariff that he intends to impose. So we'll see. Nothing's guaranteed here, but I think the outlook is brighter. I think the stock market discounted a lot in terms of the profit margin being boosted by a tax cut, and I think that's a good move that makes sense.
And we'll definitely be watching that and the bond market very closely. Ed,
Sure.
Always great to catch up with you. Thank you so much.
Thank you.
Well, investors are, just as we have been, taking stock of 4 more years under a Trump administration. It's a busy week ahead for investors as well. We've got earnings, we've got CPI, we've got retail sales. Oh, and one more thing, Yahoo Finance's Invest Conference is going to be talking about all of those things. The event's going to feature some of the best and brightest minds across various industries, all under one roof. Coverage begins at 8:30 a.m. tomorrow with the taping of executive editor Brian Sozzi's podcast, Opening Bid, from that event. And of course, Josh and I are going to be there taking folks throughout the day. So it's going to be an in-person event, but we, of course, will be streaming it here live on Yahoo Finance. Both Josh and I will be talking to some interesting folks throughout the day.
Yeah, I'll be sitting down with Brian Schimpf, who is the CEO of Anduril, defense tech startup, which is very well timed, Julie. Obviously, President-elect Donald Trump, lots of debate and discussion, what exactly his foreign policy stance could look like, how it will compare and contrast to Biden's. I'm interested to hear what Brian thinks about that, and then how does that, he think, sort of impact and influence his company and that broader defense tech space. Anduril, you know, it's a startup, so only been around for about 7 years, but already valued at about $14 billion.
Yeah, I'll be talking, as we were just looking at, to Rick Reeder of BlackRock, CIO of Fixed Income. And as we were just talking about, sometimes the stock market and the bond market don't tell the same story. They don't sing from the same playbook. And he's really zeroed in on the story that the bond market is telling in the wake of the election and what we could see next. There's predictions for more volatility there. So we're going to sort of dig into that and talk about what could happen if indeed we see growth in deficits, what's a best case scenario, what's a worst case scenario. And then also talking to Margaret Anadu of the Vistria Group. She does investment in affordable housing. She did that at Goldman Sachs as well and has built up a big portfolio at a really key time for the housing market where there is an affordability crisis. So that's going to be really interesting.
All right, lots of great discussions on the way.
Indeed. In the meantime, we're still here. We're just getting started here on Market Domination. Coming up, Bitcoin setting another record as the post-election rally continues. Investors continue to pile in, including MicroStrategy. More on Michael Saylor's latest crypto moves is coming up. Plus, Disney will report its latest results this week. TD Cowen's Doug Kreutz will join us later this hour for what to watch from the entertainment giant's earnings. Stay tuned. More Market Domination still to come.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Time now for some of today's top trading tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, we're looking at MicroStrategy. That company buying more Bitcoin, yet more Bitcoin, for about $2 billion here. The stock is surging by 26%. It bought about just over 27,000 more Bitcoin, now holds a total of, ready for this, 279,420 Bitcoin, about 1% or so, give or take, of all the Bitcoin out there.
Yeah, per Bloomberg, this is the biggest purchase by the company since just after it started acquiring the asset more than 4 years ago. Apparently bought the cryptocurrency, it sounds like, Julie, between October 31st and November 10th. MicroStrategy stock now up a cool 400% this year.
Yeah, 400%, by the way, which is more than Bitcoin is up. Let us make no mistake here. And Barron's had an interesting piece where they looked at the premium that one is paying for MicroStrategy shares over Bitcoin itself. According to their calculations, it's about 3 times the value of its Bitcoin stake. So the premium has been rising and getting more stretched as it really doubles down on this strategy of selling stock in order to buy Bitcoin. It's effectively a leveraged bet on Bitcoin, and one that a lot of people have been participating in. At the same time, you know I love my short interest, Josh. And S3 Partners says that MicroStrategy's short interest is 18% of float. So when you see a move like this today, you've heard me say it before, a short squeeze is almost certainly part of that move upward.
And look at this, the street, by the way.
Loves it.
8 buys, 0 holds, 0 sells. Nothing but love for MicroStrategy.
I will say that the average price target of those 8 analysts is around $300 or so, which is above where it is right now. Will we get some neutrals in the weeks ahead after we see this surge? We'll see.
We will wait and see.
Maybe.
Moving on, let's check out Chipotle appointing Scott Boatwright as its permanent CEO and member of the board. That is effective immediately here. He had been, of course, serving as interim CEO. Julie, we talked to analysts about this. This is Brian Niccol, departed for Starbucks. He was COO before that. Not terribly surprising. We had talked to analysts who come on the show and said this is the move they expected. Yeah,
and he was the COO before that, so he's been on the management team for a while. And it's funny when we've been asking analysts, okay, what does he need to do at Chipotle? And they kind of say, nothing. He doesn't just
keep it going.
Not change anything, because Chipotle did have some numbers earlier in the year that weren't necessarily as strong, but you know its performance has been pretty remarkably steady in terms of the growth that it's had, the same store sales growth that it has had. So including in its most recent earnings report.
Yeah, stock up about 30% this year.
Yeah. All right, and let's also talk about one pharma story. AbbVie shares are sliding after its schizophrenia treatment failed to meet its primary goal for 2 mid-stage trials. That setback helping to lift shares of its competitor Bristol Myers Squibb, which makes a similar but slightly different, or is developing. So AbbVie shares are tumbling today, and analysts were pretty scathing about this failure, especially because AbbVie acquired this drug through an $8.7 billion acquisition of a company called Cerevel Therapeutics. And so there's a lot of shade being thrown by analysts on the wisdom of that acquisition for this thing that, at least right now, doesn't look like it's necessarily going to pay off.
Yeah, for AbbVie, this was actually the biggest intraday drop since March 2020. So it really got hit on this. Some clearly on the street seeing this as a win for Bristol Myers, by the way. In September, remember, they got U.S. approval for the first time, first new type of schizophrenia drug in decades, actually. I saw some analysts saying, listen, AbbVie news here does significantly bolsters Bristol's lead in the market. You can see that in the shares.
Yeah, and again, it's what AbbVie is developing is similar, but different enough that it seems like Bristol obviously was able to get that approval.
Yep. All right, moving on. Healthcare insurer Cigna announcing it is not pursuing a combination with Humana. Shares of Humana sliding, with Cigna's stock rising in today's trade on the announcement. For more on what this means for the healthcare market, let's get to Yahoo Finance's Anjali Kamlani. Anj.
Yeah, this is the biggest will they, won't they story of healthcare, really. We know we've heard about this potential merger for quite a number of years, and we got word from Cigna CEO David Cordani saying finally no to end the speculation, no to end any more commentary on the subject and reports recently that popped up. I mean, this story goes back a few years. If you check out the timeline, we've heard about Cigna's interest in Humana over the years, even during the time period at some point when Anthem was looking to acquire Cigna. And then you fast forward through, there's been rumors about it. They've attempted, they've had FTC IXIC come in and chat about it. So it's been one of those stories over time to check. And the timing of it this year and the past year we've heard about is the most interesting, because if you take a look at the market share, Humana is second in the market in terms of Medicare Advantage enrollment. And that is huge. It has maintained its market share for a number of years. The timing now is a little bit rocky. Humana lost a number of its higher star rated plans, according to Medicare, and it is looking at potentially seeing a loss of enrollment for the first time, significant loss of enrollment to some of the other competitors. CVS, for example, could potentially pick up some of that because it got higher rated plans in the process. So there is going to be an interesting shift in the market this coming year, and how Humana holds up will be the story. It's a typically very favored insurer because it has really nice benefits that a lot of other plans don't offer. So that's what's going to be interesting, is how the market plays out with this, how Humana maintains its market share, and what that means, because they've been under a lot of pressure. They're seeing the same increased utilization that other companies have been seeing, but they only rely on this market largely, whereas in other players like CVS, like your Uniteds, right, they've got broader portfolios. And so that's where we've seen the struggle in those like sole Medicare Advantage players. You can see it in the stocks, the news, really good for Cigna. No one wants them to take on the debt of this and take on, Humana at this time. Humana was down more significantly this morning, but has managed to pare back those losses and is still up on the week. So good news there.
Thank you so much, Anj. Appreciate it. All right, coming up next, we're going to be talking about which sectors are poised to win under the incoming Trump administration. We'll discuss that with one wealth manager next, with top themes that he is watching.
With the presidential election finished and growing possibility that Republicans could secure control of Congress, the market has begun to sort through the winners and losers. Our next guest cautions against significant shifts in your portfolio, but is keeping an eye on several key themes under the new administration. Joining us now is Paul Karger, Twin Focus co-founder and managing partner. Paul, it's great to see you. So listen, post-election, Paul, I'm curious, when you look at the markets right now, what do you think the signals the markets are sending us as investors?
Josh, great to be here. You know, post-election market response has really come through continued, animal spirits and risk assets. You've seen soaring mega cap stocks. You've seen rallying small caps, regional banks, financials, soaring Bitcoin, and other crypto-related assets. So it's risk on for now.
And is it risk on for everything, Paul, I guess, is part of the question. And should people be sort of reweighting their portfolios in terms of which sectors?
So I'll break that down. It's certainly not been risk on for everything. It's been a bit risk off for the more interest rate sensitive sectors, such as real estate, some healthcare, renewable energy. The Trump administration has been, as we know, focused around taxes and tariffs. So folks are starting to think through what kind of impact any kind of change in the tariff picture that will bring upon the markets. Certainly tax policy, immigration as well. Limiting immigration can be inflationary. And so the market has been concerned about inflation. You've seen the 10-year back up. In response to that potential. You've seen gold has continued to do well, and potential other inflation hedge here is again crypto.
Let me, Paul, in terms of other themes, I know you're watching the markets. Another one I want your take on is that mega AI trend. I'm curious what you're looking for there, Paul. There are certainly some analysts who are betting that a Trump administration is going to adopt a kind of more laissez-faire approach to AI.
We tend to agree with that. I think it's, AI coupled with technology. Tech has been really hot this year. AI has carried the markets this year. Maybe on a short-term basis, it feels like that might have gotten a bit ahead of itself. But absolutely, AI infrastructure. It's why we continue to like data centers, utilities, just simply not enough power out there today to fund and fuel AI.
And Paul, I know you're looking at some of the energy, some parts of the energy market as well. How are you approaching that? Because on the one hand, more production, opens up new areas for many of these companies. On the flip side, could put downward pressure on prices potentially if there's more production.
Yeah, I think it's going to be really a tale of two cities. A lot of this is going to have to do with what goes on with foreign policy. Lots of question around that. As we know, Trump is a different animal, and he's taken his approach to foreign policy by calling leaders and trying to sort things out. So there's a lot of question there. I was in Europe last week meeting with investors and clients, and still lots of concern about how Russia is able to interplay providing commodities to the rest of Western Europe. Obviously, here in the U.S., taking this protectionist bent, we've been really kind of patriotism. We've really kind of focused on this domestic energy production. So it's going to be really dependent on which region you're talking about. But by and large, we tend to be pretty bullish here, especially in an inflationary environment on commodities.
Paul, let me get you take a kind of a broader question. We could talk about this sort of near to intermediate term moves here. I'm just curious, Paul, did your sort of long-term strategic portfolio views, did those change because of this election?
Not really. That's a great question. Historically, elections have been really noise. And going into an election, I think you need to ensure that you've got proper portfolio diversification. Everybody's been focused on over concentrations to the U.S. Over the last decade plus has worked really, really well. We are urging clients to think about international diversification. But by and large, we're not making big swings in our asset allocation decisions based on the current results of the election.
A quick question on fixed income as well, because that's also one of the areas that is sort of up for grabs. Understanding that you're not making big changes, what are you watching most closely?
Sure. On the safer fixed income side, we have stayed closer on the curve, shorter on the curve, especially with our treasury allocations. There is some concern over municipals. We're not adding to our municipal exposures today. There's some concern that the taxability of those and the lack of taxability may go away. Jury's still out on that, so we're not looking to increase those exposures. High yield has done really well for us this year in a risk-on environment, but we are staying shorter duration with our fixed income.
Paul, thank you so much. Paul Carger, good to see you.
Great to be here. Thank you.
Thanks. Got a call of the day to talk about now. Analysts at JP Morgan Chase have upgraded Cisco Systems to overweight from neutral ahead of its first quarter earnings, making the case the stock still has room to run. It is up over 28% since reporting its fiscal fourth quarter results back in August. And it's interesting here, Josh, because yes, it's ahead of earnings, but they caution that it's not necessarily that earnings are going to be fantastic. They emphasize that this is more of a medium-term sort of cycle turn call, rather than saying like this earnings report's going to be great and then it's up and away. It's more like we want to get ahead of the next cycle.
Yeah, it's interesting because they move in. Cisco just hit a 52-week high, and the stock has enjoyed this strong run since the company last reported. And JP Morgan, acknowledges that in their note to clients, but they raise it anyway to overweight, target 66. A few different reasons, to your point, Julie, are these kind of broader themes they're saying. They talk about a recovery in networking. They emphasize networking demand is on a recovery trajectory to support estimate upsides. They also talk valuation. They say there is modest room for upside to the valuation multiple. Historical precedent being for a peak multiple, they told their clients, of 18 times versus the current 16 times.
Yeah, so we'll see if there's further room to run there and see what the earnings show. And by the way, make sure to tune into Yahoo Finance on Thursday when Cisco CFO Scott Herren is going to join Morning Brief to discuss those earnings. We'll see how they do. Well, Tesla CEO Elon Musk, who has backed President-elect Donald Trump, is now endorsing the idea of allowing presidents to intervene in policy decisions made by the Federal Reserve. Joining us now, Yahoo Finance's Jennifer Schonberger, who covers the Fed for us. And of course, there's been a lot of talk about whether this Fed will be able to be as independent under a second President Trump term.
Yeah, absolutely, Julie. As you mentioned, Tesla CEO Elon Musk now joining the chorus of those who are endorsing presidents allowing to intervene in policy decisions. Musk responded 100% in response to a post on X Thursday from Republican Senator Mike Lee, who called for the Fed to be under the direction of the president. The comment comes after President-elect Donald Trump said during his campaign that he would like a say in setting interest rates and that the Fed chair has gotten it wrong a lot. Trump criticized Fed Chair Powell for cutting 50 basis points in September, calling it a political move. Last week, Powell was asked whether the president has the legal authority to fire him or other top Fed officials, to which he said it's, quote, not permitted under the law. The Wall Street Journal this morning reported that Powell was prepared to go to court when then President Trump floated his dismissal 6 years ago in a move to protect Fed independence. The president-elect has not said anything in response to Powell. Fed independence is one thing I'll be asking Minneapolis Fed President Neel Kashkari when I sit down with him tomorrow. Guys?
All right. Thank you, Jennifer. Appreciate it.
Thanks so much.
Meanwhile, the Walt Disney Company is set to report Q4 earnings Thursday morning. Analysts expecting higher revenue and profits and maybe even some details of a succession plan for CEO Bob Iger. Joining us now is Doug Kreutz, TD Cowen, Managing Director, TMT Media Entertainment. Doug, always good to see you. So you got a hold rating on Disney, Doug. You're not a believer here. What keeps you on the sidelines?
Well, I think it's a combination of a few things. One is they've had an incredible run in the parks division for the last few years coming out of the pandemic. The margins are as high as they've ever been. It's becoming a bit hard to see how that margin expansion continues, or it continues at anything close to the rate it's been going. They talked about some booking softness over the summer. Maybe that's gotten better since then, but it's clear that we're not going to get the sort of double-digit growth there that we have been getting. Linear media continues to be a major headwind, as it is for all of these companies. When you're losing subs at 8% of your sub base every year, it's tough to overcome that. DTC, they've gotten essentially to break even by taking a lot of costs out, but they haven't had organic sub growth really in a while. They're raising price as fast as they can, but it's not clear to me that DTC is going to improve profitability faster than linear loses profitability. And then you've got the movie business, which had a bit of a renaissance over the summer with Inside Out 2 and Deadpool and Wolverine, and they should have a very good fiscal Q4 with Moana 2 and Mufasa. we'll see how next year goes. They've got a bunch of Marvel movies starring sort of second and third tier characters. They've got an original animated film. Those have had a tough go at the box office. So, I think they're fine. We still don't have a clear line of succession on Bob Iger, and we're a year and a half away now from when he's supposed to be leaving. I think without knowing who's going to succeed him, it's very hard to get too bullish about the company.
Yeah, all of those are good points, Doug. I'm curious what you think strategically Disney could be doing better. Like a lot of those things, some of them are in its control, some of them are not. What is within its control that it really needs to focus on and do better at this point, leaving aside the succession situation for just a sec?
Look, making good content obviously is, or at least mostly, in its control. And I think they've made some headway on that. The mix in their pipeline has gotten better since Iger came back. And they had a stretch there where it was basically all original animated films and no sequels. And the next few years look a lot more balanced in that regard. They've sort of talked about limiting quantity at Marvel and getting back to quality a little bit. So I think they're doing things in that direction, and that'll help. But, sort of bigger strategic picture, linear is facing a massive headwind. Like, there's nothing you can really do about that. They're trying very hard to right-size the cost base across linear and DTC. I think they've done a lot of work there, but at a certain point you start cutting into bone. Their main issue on DTC is that their revenue per subscriber is still well below where Netflix is. And that may take many years to catch up, right? I mean, Netflix has been raising price for a long time. Disney just started raising price a couple of years ago from a very low price point. So, you raise price too quickly and then you lose a lot of subs. So I don't know that there's any easy solutions here, which is why I have a hold on it. Because I think if there was something I thought that they could do to make things a lot better, I sort of think they also would do it. And I don't think there's any great silver bullets here to solve some of the issues they have.
In that streaming market, Doug, it was interesting. After Netflix reported last, there was an analyst who covers the name, and I remember he told his clients, he looked at that report and said, listen, Netflix right now just has a virtually insurmountable lead in the streaming wars. I remember that's how he put it to his clients. Do you agree with that, Doug? Is that how it sort of just shakes out right now?
Well, if you have an industry where there's going to be many winners, or at least many survivors, I don't know that having an insurmountable lead is the end all be all. Like, it's good for Netflix that they're in the position they're in, for sure, right? And they've got a sustainable business and a profitable business, a scaled business, right? But, if you're Disney, if you're number two, like, just because Netflix is number one, it doesn't mean that there isn't a lot of money to be made at number two. This is not a market that's going to consolidate on one company making all of our television shows and all of our movies. If it does wind up that way, then, some people somewhere have missed the boat really badly in terms of regulation. But, this is Hollywood has always been an industry where there's been, 3, 4, 5, 6 players that are profitable. And I don't think that, streaming happening that necessarily changes that much. It's just gonna take time. I do think Disney will get there eventually to where they have a healthy growing media business because they have great content. But it could take a while. Think about what the music industry went through, right? In 2000, they sort of hit a peak in revenue. And the next 15 years, it was all down. And the last 10 years have been pretty good and getting better, right? The music industry is doing really well again. These technological transitions can take a long time to get through. Makes it tough if you're an investor, sort of, how long am I willing to be patient?
Doug, there's something else I want to ask you about, which is the political environment right now. And, it's not relevant necessarily for all companies, but this is a company that has, at least in Florida, had some political arguments. It has been a target of the right at one time or another. Is that a risk at all now that Donald Trump's going to be president again?
I don't think so. I mean, they had some specific issues in Florida that I think had to do with Bob Chapek not really being super well equipped to handle some of those external relationships. He hadn't had a lot of experience and he didn't get a lot of training and he fumbled the ball a bit. I think Iger has worked really hard to fix that particular issue. Beyond that, the content they make at the end of the day, if it's good, no one's going to complain about it being too woke or whatever. If it's bad, then you're going to hear the complaints. Again, the issue that they've had the last few years hasn't been sort of the political substance of their content. It's been that they've made a lot of movies and TV shows that were, kind of mediocre. And again, they seem to be coming out of that, at least to a certain extent. And I think that's the only thing that matters for them.
Doug, always great to see you and have you on the show. Thanks for joining us.
Thank you.
The oil market is feeling the weight of bearish fundamentals. We're going to discuss what's next for the energy market with an energy trader. It's coming up next.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Oil is extending declines for a second day amid concerns around China demand. Weak consumer data over the weekend and Beijing's disappointing stimulus stoked investor fears for the world's largest crude importer. Joining us now is Rebecca Babin, CIBC Private Wealth U.S. Senior Energy Trader. Rebecca, it's always good to see you. So obviously there are a lot of dynamics at play in the oil market right now, as there always are. But let's take that China factor first of all, right? Because there's been such a whipsawing in expectations this year in terms of what people are looking for out of China. Where do you think it sort of all settles out?
So that's a great point. And China, as I like to say, has been the boogeyman under crude oil's bed for the better part of 6 months, right? We came into the year with pretty high expectations of Chinese demand, and it's gradually just kind of gotten revised lower as the year has gone on. And you're right, what we're seeing right now is kind of this kind of giving up. Okay, we're not seeing any improvement. They're not bringing out enough fiscal stimulus. We're going to also be battling potential tariffs. We're also going to have a stronger dollar. And so we're seeing kind of the even lowered expectations get ratcheted lower yet again for 2025. And though China is kind of going to cede its most important oil importer status to India in coming years, it's still very relevant for the growth story. So it's still kind of that barometer that many traders look to as kind of the litmus test of how demand growth is going to shape up. They kind of just check China first and then kind of draw the rest of the map out. And China is really, really kind of underperformed, and there's a lot of concern about what 2025 looks like. So with that context, it's really hard for crude to start to have a meaningful rally without that kind of demand engine that we've come to rely on to fuel crude higher behind us. And that's before we even talk about what's happening with supply. So that's a big part of the story of why many rallies this year have faded and failed to really gain the upside momentum, even with so many geopolitical risks outstanding. Without that growth engine, it leaves a lot of investors on the sideline and unwilling to kind of jump in and take a bet that crude's going to have, a sustained rally.
Rebecca, I want to bring you here back to the U.S. as well. So, Donald Trump's moving back into the White House, and a Republican mantra, Rebecca, and you know this, has become, drill, drill, drill. So how is that actually going to play out? Would you expect to see, Rebecca, some kind of, meaningful jump now in U.S. production?
So the drill baby drill narrative certainly impacts sentiment, because I think there's an expectation that U.S. supply is going to grow. The reality is U.S. shale and oil companies are using the mantra earn, baby, earn, right? They are optimizing for profitability, free cash flow, and delivering money back to shareholders. And they only do that when crude prices support growth. And right now, where the strip is, if you look out into 2025 and 26, we're in the mid 60s, and that's just not a place where you're going to see explosive growth. Even if regulations are loosened up, the market dynamics overwhelm what regulation can do in terms of production, increased choices for U.S. energy firms. So I don't think we see this massive increase in U.S. production as a result of looser regulation. On the margin, you may see a little bit of increase, but it's not going to be enough to move the needle. And I'd further this point that what we've seen over the last 2 years is a significant amount of mergers and acquisitions in the energy space. So you went from having 20 players, some of them small, some of them very aggressive, independent kind of wildcatters drilling for oil, to now kind of 7 or 8 consolidated bigger players who are optimizing much more conservative approach and looking at the big picture, and not necessarily going to respond to kind of micro moves in the market. They're going to look over the long term and make their decisions that way. So that's another reason why I don't think you see that explosive growth. You've got a different kind of group of decision makers in the room when it comes to energy players.
Well, and to be clear, Rebecca, I always love when we have this conversation about drill, baby, drill. The U.S. produces more oil than it ever has, right? Like, we already drill a lot, but enough to become energy independent. But I am curious, there's regulation, there's approving, permitting, and then there's sort of more the soft political push, right? Are we going to see, for example, if prices start to go up, are we going to see some pressure from the White House, for example, to try to produce more?
So, Julie, you're absolutely right. The U.S. is and has had tremendous amount of crude oil growth. Even over the last year, we're looking at 500,000 barrels a day, and we're going to grow 500,000 barrels a day next year, regardless of who was president. So you're right. it's not like we're not growing. So that's a great clarification. When it comes to the political pressure that I think you will see, I think you're nailing it. There's going to be rhetoric around the need for U.S. Energy companies to ramp up production, take more aggressive action. But we saw that many times under Biden. We even saw it a little bit under Trump. And it's just words. Ultimately, these companies have been burned through several other cycles when they've taken the bait on increasing production, on smaller moves, easier regulation, and guess what? They ended up in the high yield index, right? Because they were over levered and they weren't making enough cash. They're not doing that again. And I think if you listen to the commentary coming out of the larger producers on their last earnings call, when they were asked about this exact topic, they said, we are making decisions based on the long term. We don't think looser regulation or any of these changes is going to significantly change our plans. And I take them at their word on that one, not only because they want to return money to shareholders, but because they've been burned in the past by not following this rule.
Rebecca, really quickly, I know it's a big topic, but really quickly, the other change that we can see under this administration is tougher rhetoric and also action towards Iran. What effect is that going to have on the oil market?
Great question. So that is an interesting one. There will be tougher rhetoric and potentially much tougher sanctions on Iran. Iran is currently exporting 1.5 million barrels. We could see 500,000 to 700,000 come off due to tougher sanctions. The counter argument that's come up, though, is that Trump has these great relationships in the Middle East, and he's going to have Saudi Arabia and OPEC fill that gap immediately. Thus, it's kind of offset, and we don't need to worry about that supply disruption. That's how the market sees it. We'll see if that's how it plays out.
Rebecca, always great to have you on the show. Thank you so much for your time.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.
There's a closing bell on Wall Street, and now it is market domination overtime. Oh, look at the opening bell on this Veterans Day there at the New York Stock Exchange. Let's take a look at where the major averages ended the day here. We've got the Dow higher by 305 points at a record here. It's the winner of the day, up about 2/3 of 1%. It did fade a little bit as the day went on. The S&P 500, 51st record of the year with the gain of only 1/10 of 1%, but it closed at a record on Friday, so it's another record close today. And even the Nasdaq just squeaking out that positive finish just barely by the end of the day here. As we've been seeing here today, the equal weight outperforming the S&P 500 and the Russell 2000 outperforming by a wide margin, up 1.5% to just 1/10 of 1% for the S&P 500. So people continuing to get into small caps. Not everybody is on board. Michael Kanrowitz over at Piper Sandler pointing out that you're still not seeing these companies as profitable as you'd want to see them for the kind of rally that we've been seeing, but we'll see how it continues to play out. We've continued to watch Bitcoin, as we've been talking about throughout the day. The bond market, by the way, is closed today for Veterans Day, but continuing to climb here, Bitcoin making new highs throughout this session. In terms of the stocks on the move today and what we've been watching, I did want to start with the Dow since we saw that as the outperformer today. Now, this is market weighted here. Let's take a look in equal weighted to get an idea of what we saw. Salesforce up big today on some positive commentary from analysts at Jefferies, Honeywell, Goldman Sachs, Amex, Disney on the list there. It's reporting earnings later this week. Those were some of the stocks gaining the most today. On the sector level, when you look at the S&P 500, real estate and healthcare down. Consumer discretionary making another new high today, up along with the financials. Speaking of financials, we're going to hear from Bank of America CEO Brian Moynihan tomorrow at our Yahoo Finance Invest conference. So that's going to be an interesting discussion here. And then taking a look at the leaderboard. Jared isn't here today, so I'll do it in his stead. Of course, a lot of crypto-related stuff here. Grayscale Bitcoin Trust up the most today, 13% of this leaderboard. ARK Invest also trading higher. Regional banks catching a bid today. So pretty diverse group of stocks doing well. Cannabis, though, in the losing spot, down 7%. Josh?
All right, Julie, gains across the board on Wall Street as the Trump-fueled rally drives the Dow and the S&P 500 to new highs here. And our next guest says that even though the market technically qualifies as a bubble right now, it does not look toppy. Joining us now is the Leuthold Group Chief Investment Officer, Doug Ramsey. Doug, it's good to see you. Let's start there on that point, Doug. You say what we have here is a genuine stock market bubble. How so, Doug? Quantify that for us.
Probably back in February, March, we designated some levels on various valuation measures that we just drew a line historically and said, look, whenever the market has traded north of 21 times forward earnings, it's been in a bubble. So I'm talking about 1999, 2000, and then again in 2021, the mania following the COVID bailouts, right? When it's been north of 18 times cash flow historically, it's been in a bubble. It's 20 times today. We do something akin, you may talk on the show about the Shiller PE ratio. We've got something similar. We don't call it the Leuthold PE ratio. We should, but it's a 5-year smoothing of earnings. So our normalized PE ratio, as we call it, is 32.5 times. Every time you've been north of 30, you've been in a bubble. So really just looking historically, just using simple line drawing techniques, we're just saying, look, when you've been here before, you've been in an equity market bubble. So now every one of these metrics, and there are a few more I won't get into, but all of them are now trading at levels which have never been seen outside of bubble zones. So I think we're there. I get that maybe the enthusiasm from the retail crowd is not maybe what it was, for example, during the internet bubble, but just empirically, and I think based on forward returns from here, we're there, regardless of how people feel.
Doug, it's really interesting that you're talking a lot about these sort of bubbly valuations, because we talked to Ed Yardeni earlier today, and he has a new target for the S&P 500 by the end of next year to reach 7,000. And he too brought up valuations, but in his view, earnings growth is going to be able to grow quickly enough that he thinks valuations, and here we're showing his chart of valuations going higher really across the board from small all the way up to mega caps. He thinks earnings growth is going to be able to be robust enough that things will not continue to look as expensive. What do you think of that view?
I'm skeptical of that argument with respect to the large and the mega caps, because that's where the margin expansion has been historically. So expanding margins from here, let's say for the average S&P 500 stock, I think is going to be really tough. But he's not wrong when you look at mid and small cap margins. I mean, they're somewhat above historical averages, but they're not exceptional. And at the same time, valuations on small caps and mid caps are pretty average. I'd say on small caps, they're dead on their long-term historical averages. For mid caps, we'd say, they're maybe on the high side of their neutral zone, but certainly there's no reason to dump mid and small caps on a valuation basis. I mean, if you're worried about a recession next year, then yes, you probably should. But we just put out a report last week looking at what mid and small cap returns could be over the next several years. And to us, they look maybe average or just shy of average, whereas the same exercise, and again, when it comes to managing money, our long-term return forecasts are not a big part of what we do, but we do look at them to assess the overall risk environment. But our forecast for the S&P, derived from many of the same measures, would say more like 3% returns looking out several years, and average returns, again, for mid and small caps. So I do think there's much better value there.
Let me ask you, Doug, got your view of the broad kind of gauge there, but under the hood, I'm curious, what sectors would you favor here, Doug? Which ones would you be selling?
We've been trimming back on our tech holdings here for a number of months, and we're underweight tech now relative to the S&P for the first time in at least a couple of years. What we're seeing sort of bubbling up, if you will, in our industry group rankings is more value-oriented groups, and in particular financials. We're now at 24% financials in our select industries portfolio. We have bought regional banks, the reinsurers, and also P&C insurers. So, and that's the quantitative work speaking. And what's interesting is very often we don't have a good narrative for a while until we've been in those groups for a while. In other words, the quant work sort of sniffs it out first, and then we start to see the fundamentals fall in line, and then the narrative kind of develops. So I don't have a great story other than, higher inflation would clearly benefit the P&C insurers, and it has of late. And there has been a relationship between higher interest rates, higher bond yields, and the bank stocks outperforming in the recent past. So those are a couple of reasons, but I think it will become more obvious if those moves persist as to why we bought them a while back. But overall, I do see a rotation away from the large cap growth leadership that has just dominated throughout this bull market, and quite frankly, even throughout the prior bull market. I do finally think that leadership torch is being passed over to value and to secondary stocks, small and mid caps.
Well, certainly that group has a lot of fans right now. We'll see how it plays out, Doug. Great to see you. Thank you so much.
Great to see you. Thank you.
Thanks. Well, many expect President-elect Donald Trump to usher in an easier era of deal-making, from deregulation to mergers and acquisitions. It might not be that simple. Joining us now, Yahoo Finance's Alexis Keenan. This has been the broad assumption by the market that the Trump administration will be friendlier, that we will see this wave of
a lot of
deal-making
exuberance, right? And some attorneys, former DOJ officials, former FTC officials, they tell me that maybe that's a bit of irrational exuberance, particularly because if you look at the data, particularly for mergers, right? So this is what we're drilling down here at Yahoo Finance's, the merger side, not necessarily the conduct side, but the thinking is, right, that a Trump 2.0 is going to bring this less scrutiny to antitrust. But if you look at the data for mergers, you see that the Trump administration brought comparable
comparable challenge to what the Biden administration did. And that's even if you include the data from 2022, which was a record-breaking year for the Biden administration, easy for me to say. They had 50 merger challenges that year. So if you look at the reports that come out of the FTC and the DOJ, these are required reports they have to file each year, but they don't necessarily align perfectly with the administration's because the fiscal years run October through September. But what you find is during the first 3 years of each of those terms for Biden versus Trump, you have Trump opening more full investigations that are known as second requests, asking companies to drill down and give more information about why their merger should be approved. You have 157 total during those first 3 years of the Trump administration versus 149 with Biden. You have Trump seeking to block more mergers, 116 over that 3-year term for Trump versus 110 for Biden. And then also Trump issuing at a higher rate of second requests. So if you take all of the required filings, all the companies that had to file because they met a certain threshold, a dollar threshold, Trump's second requests were coming in at a higher rate. If you look, I think we have a graph here. Going back to 2018, you see 2.2% challenged transactions, 2019, 3%, again, 3% the following year. And then you see a dip 2021 through 2023 under Biden, 1.9, 1.6, and 2.1%. So there is some thinking, though, that maybe the Biden administration has been a bit more selective because if you look on the DOJ side and you look at the conduct side, different type of antitrust enforcement, right? There were quite a number of Section 2 cases brought. There were also Section 2 cases brought under Trump. This is where the company is allegedly making illegal conduct in the antitrust sphere by having a monopoly that is not acting right. So if you think about Trump's administration investigated Google, also Meta, also Apple, launched that Apple investigation, then sued Google. Then you have Biden kind of picking up the torch there, going after Google a second time, going after Apple, also Meta in there as well. So, and Amazon, I should say too, Live Nation, Visa. So picking up pace in a different sphere, but certainly the numbers don't necessarily bear out that a Trump administration a second time over is going to go light on mergers.
It's interesting, Alexa, because you mentioned Google there. I mean, Trump was recently asked about Google and would you break them up? And he suggested, kind of indicated he wouldn't. And then the way he kind of, and further, what I thought was fascinating was the way he sort of talked about them as if he kind of really does believe like these are really important economic assets on this sort of giant geopolitical chessboard he sees with China. Some of his language there I thought was very interesting.
Yeah, and the attorneys that I've been talking with, they do suspect that Trump will be more of a negotiator, wants to tie up and settle these matters before litigation is brought, as opposed to just waiting for all these filings and then dropping the lawsuit on the table. The thinking is that he might be trying to broker things before they run amok.
Yeah, interesting. Alexis, thanks so much.
Yeah.
Great story. Reminder that tomorrow, by the way, is the 2024 Yahoo Finance Invest Conference starting at 8:30 a.m. We're bringing you conversations with some of the best and brightest minds across various industries. Watch it live here on Yahoo Finance. More market domination overtime coming right up.
An inundation of cheaper cars may be coming to the EV market, but not straight from the factory. Here with more Yahoo Finance's Pras Subramanian. Where are they coming from, Pras?
So it turns out, J.D. Power did a report, and it turns out a lot of EVs are coming off leases in the next 2 to 3 years. So, we had a steady climb of EVs on leases recently, and then with the passing of the IRA tax credit, it's a huge boon for leasing because you could apply it to any EV, not just ones that are cheaper or for a buyer that had a lower income level. So basically they did the numbers, and by 2026, from now we're around 65,000 EVs coming off lease. By 2026, it'll be 215,000, basically 230% more than it is now in 2 years. And that's all going to come to dealer lots, right? And right now we're already seeing EV prices come down, used EV prices come down. Imagine 2-3 times the amount of EVs coming to the dealer lots over time. You're going to see better prices for people that want cheaper EVs, and that's sort of the benefit of this.
And when we talk about this EV sales growth, this is often billed as a primary reason, right? It's the price point.
That's one of the things that we've done. We did a Yahoo Finance Ipsos poll, and one of the biggest barriers to EV penetration or adoption was price. And that's steadily coming down. We just spoke about right now, where's Tesla's cheaper EV? That's supposedly coming. And is that going to add more sort of downward pressure to these EVs? And then the question is, who can make them at a profit? And that's the other big question. But when it comes to used EVs, if you're a consumer, you're in good shape, potentially on the line.
I want to ask you another question about used EVs. For a while, when electric vehicles were first introduced, the technology was moving pretty quickly and advancing. Where is it now? In other words, if you buy a used EV at this point that's a few years old, has the current technology advanced to such a point that you're really getting something kind of obsolete, or is it sort of stable now for the past few years?
That's a really interesting question, because I feel, as someone who covers the industry, I feel like right now we're at, steadily, you got incremental improvements here, you have better software, more efficiency. The battery technology is improving, but it's still these heavy batteries. I think by 2026, you might hear about these solid state batteries that are cheaper, lighter, hold more energy, but they're expensive. And that's the big next step that everyone's hoping for, but it may not come in 2 years, it might come in 3 or 4. In that case, right now, you might be getting a good deal on a good EV, and then they can be updated, right? So they can improve efficiency.
Well, they can be updated if it's a software update.
Yes,
They're not going to switch out the battery if it's the new kind of battery. But so that's, because you want a cheaper one, but you don't want one that's obsolete by the time you end up
Right, and that's why we're seeing these lower extreme depreciation, but also because Tesla cut prices so severely. If they didn't do these severe price cuts, I wonder where we'd be today with depreciation.
We'll never know. Pras, thank you so much. Appreciate it. Well, as storms such as Hurricane Helene are becoming more severe and more frequent, we're looking at companies that are feeling the ripple effect. One of them, Advanced Drainage Systems, a stormwater infrastructure company with billions of feet of pipe in the ground in the United States. Joining us now, the CEO of Advanced Drainage Systems, Scott Barber. Scott, it's good to see you again. Thanks for being with us. We talked about this effect a little bit last time. That was sort of, I guess we were earlier on in the hurricane season, right? And we hadn't yet seen some of the activities and some of the effects that we have seen. Have you guys been having sort of a busy couple months of it?
We have. Thank you for having me on again. And I think when we were last together, we had some bigger rain events in the tri-state area, and particularly in New Jersey. And these were even bigger, more severe rain events that we saw in Florida and then moved through the Southeast. And as you know, this is really where our products are installed and where we participate in the economy. So we've been quite busy cleaning up from these events, shipping into repairs. But longer term, what these kind of severe events do is provide a tailwind for new projects. Often regulations are rewritten so communities can handle more water in a shorter period of time. That's really what we do. So it's been quite a busy couple of months.
Scott, in your earnings report, you talked about continued choppiness in the non-residential end market. Talk to us about that trend. What are you seeing there, Scott, and what do you expect ahead?
Yeah, well, hello again. So non-residential market, our biggest market, it is very choppy by region and by segment. Some segments are doing pretty good. in the non-residential in some geographies like the Southeast. Some are not doing very well, like the far West. And that's our largest market. It's some of our biggest products, like our StormTech chamber products, our capture products go in there. So that demand has been heard, and we had to lower our forecast for that segment from kind of low single digits to flat for the year. And we don't see that kind of changing here over the next couple of months from a demand profile.
Scott, the last time you were on, we talked a little bit about how water infrastructure is a pretty bipartisan issue. That said, I have to ask you, now that we have had the results of the election, and it looks like there is a likely Republican sweep of Congress, if you envision any kind of funding changes to the kind of business that you do.
I remain believing that water and water infrastructure is a bipartisan issue. Everyone is for clean water. Everyone is for a neighborhood that doesn't flood. Everyone is for a resilient community against these kind of events we just talked about. So I really don't see this walking back, to tell you the truth. And I haven't changed my view on that one bit since we were last together.
Scott, I'm curious, looking ahead, you've called out certain regional strength. Could you dive into a little bit more about what's driving the regional strength you see and what you see ahead in those areas?
I think it's the same regional things we've all been watching for a period of time here. People moving, the demographics shifting to the Sun Belt, to the coastal areas. We're not changing our forecast as a result of some of these things. People moving to perhaps lower tax regions in the United States, like Texas. We see a lot of growth in Texas. And so what we do is we've been investing incremental sales resources, incremental physical capacity to make our product and to ship our product into these regions. And that's how we're going to take advantage of this growth, as well as introducing products that might be, particularly designed for those regions or have higher demand in those regions.
Scott, let me ask you, I look at your stock and year to date, you're down about 3%. Is there a part of your story, Scott, that you think, investors are just misunderstanding or maybe just not appreciating enough?
Well, certainly after, we change our guidance and our stock goes down like that, we feel like we're not understood as well and maybe a bit misappreciated. And I think the number one thing is the resilience of our model. It's still a 31% EBITDA margin company. We're still gaining share in many areas of our business. Frankly, we have a demand problem in our largest market. Look at our infiltrator business, that's in the residential on-site septic, doing wonderfully, growing in the infrastructure pipe portion of our business. We have a demand in this non-res market. It impacts pipe and allied products, which are some of our better. That allied products is a very good segment for us. And that's a demand problem. So that'll work its way out. And we will continue to focus on what we can control. We're taking great care of our customers. So many of our metrics are moving in the right way in terms of safety, delivery, downtime on equipment, all these things moving in the right way. So this is an unfortunate and disappointing blip, but we'll work our way through it.
Scott, always good to have you on the show. Thank you so much for your time.
Thank you both. Nice to see you again.
Time now for what to watch Tuesday, November 12th. Starting off on the earnings front, some big names reporting tomorrow, including Home Depot, Shopify, and AstraZeneca. Home Depot announcing results for the third quarter before the open. Analysts expecting store traffic decline amid a sluggish housing market, but sales could increase as a result of recent hurricanes.
Taking a look at the Federal Reserve, we'll get some commentary from Fed officials throughout the day. Investors will listen closely for clues about the Fed's next move after it cut rates by 25 basis points at November's meeting.
And tune into Yahoo Finance tomorrow for Invest. Our interview highlights include Apollo Global Management co-founder and CEO Mark Rowan, moderated by Yahoo Finance executive editor Brian Sozzi at 8:50 a.m. Eastern. Then at 10:50 a.m. Eastern, I'm going to be speaking with Brian Schimpf, co-founder and CEO of Anduril Industries.
Then at 1 p.m. Eastern, we'll hear from Bank of America CEO Brian Moynihan. At 1:40 p.m. Eastern, I'll speak with Margaret Anadu, who's senior partner at the Vistria Group. That's where she heads up real estate. That'll do it for today's Market Domination Overtime. Tomorrow, starting at 8:30 a.m. Eastern, you can tune into Yahoo Finance Invest.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live, Yahoo Finance all day.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Another record day on Wall Street. The Dow and the S&P 500 closing at new highs. We've got a closer look at valuations in our chart of the day and giving you insight into how much more room there is to run. Plus, one of the biggest movers in the Trump trade is Bitcoin, the cryptocurrency now trading above $88,000. We're going to get expert analysis that's coming right up. And we're looking at the geopolitical risks of a second Trump administration. We're diving in on which areas you need to be watching, including China and the implications for trade and the economy. Well, it's 2016 all over again, with governments around the world racing for the hardline policies of President-elect Donald Trump to take effect starting on January 20th. And joining us now to talk about all this, Dan Alamariu, Alpine Macro Chief Geopolitical Strategist. Dan, it is great to see you. So I know, Dan, because I read your research, you told clients, listen, that Trump was going to win this thing. He's moving back into the White House. You made the right call there, Dan. I'm interested now, let's spin ahead. You look at Trump's policies. You argue, Dan, that actually they're going to turn out to be more moderate, more orthodox than perhaps his rhetoric would suggest. How come, Dan? Walk us through that.
Thank you, Josh. So I think our view, which is, again, out of consensus, is that Trump will govern in a relatively more moderate way, especially if you look at fiscal policy, at tariffs, even if you look at foreign policy. Now, the reasons for that are, I would say, threefold. So let's take, for instance, tariffs and fiscal policy. There is this view that Trump will be highly inflationary. Obviously, bond markets have moved on that, on the fear of Trump running a massive budget deficit above what it is now, which is obviously significant. We don't think that is necessarily the case. And why is that? Is because if you look at the Trump administration during his first term and even now, they have a number of, I would say, constraints and a number of incentives. So the first one of that is, the first Trump administration, and you see the same now, has had an interest in maintaining market and economic stability. For Trump, market performance has always been a gauge of governing success. I don't think he will enact policies rapidly in terms of fiscal, blowing up the deficit or putting massive tariffs immediately in place that could significantly disrupt markets and growth. The second reason, this is maybe the most important, is the fact that the Trump administration and incoming administration, his economic team, understands that basically if they were to spike inflation, they would court political defeat. If you think of what happened in most advanced economies since the end of COVID and through the massive bout of inflation, incumbents lose elections. I mean, this is the case, of course, in the United States. Last week, it's the case in Britain, it's the case in France. This is pretty well known. So this is an administration that, of course, Trump is in his last term. He does not want to stoke inflation or to tank markets, for that matter, before 2026, before the midterm elections, because if then Republicans would probably lose those, and then Trump would have to contend with the Democratic Congress for the last 2 years of his administration, making him a lame duck, and of course having to do with the fact that he will face further investigations, potential impeachments, and so forth. Third, the other reason we don't necessarily take the Trump sort of electoral promises at face values in terms of 60% tariffs on China, buying Greenland, and everything else in between is very simple. It's because Trump's economic team tends to come from the Wall Street. They're all Wall Street senior veterans. It's relatively economic orthodox. And generally speaking, we expect sort of a Ronald Reagan-like laissez-faire approach. Again, with some exceptions, there will be higher tariffs. There will be industrial policy. That was the case, of course. And this drive towards U.S. reindustrialization is part of a broader trend in the West. And it has bipartisan support. So those are the main reasons why we think that, again, a lot of the fears around this sort of massive tariffs at first, or again, massive unfunded tax cuts are maybe misplaced. That's not to say that Trump will not cut taxes. He will cut them to some extent. He will increase tariffs, but I think this will be done in a more targeted, staggered way, and in a way that does not threaten market stability or the consumer or the American economy.
I take your point, Dan, because you look at his economic advisors right now, and you make this point, both formal and informal, Howard Lutnick, Jay Clayton, Kevin Hassett, these are market-friendly guys. Want to switch gear to another issue, though, because this is a big thing, Dan. It's certainly what investors are talking about, which is whether Trump is going to meddle with the Fed. Your take on that?
I think it's a red herring. There will be noise. Again, there will be a lot of headline risk. But this idea that Trump will fire Chair Powell, I think is not going to happen. Again, if you go back a few years, Trump threatened the same thing in 2018 and 2019 and did not do it. It gets back to one of the points I've made, which is the fact that if you were to fire the Fed chair, or if you were to interfere with the Fed's monetary policy, you run a high risk of basically upsetting markets. In fact, it's almost a near certainty. An administration that, again, will value maintaining economic and financial stability in its first, I think through its term, but especially in the first 2 years, is not going to do this. It doesn't mean that Trump will not threaten to do this. Again, there will be this push perhaps to pressure the Fed. I think that's not going to work. There's going to be a lot of headline risk. I do not think that Trump will fire Chair Powell, which also, by the way, it's a legally gray area. The other point I would make is that if you're worried about Fed independence, again, who has oversight over the Fed? It's Congress. So one thing to watch is, are there going to be moves in Congress to interfere with Fed independence, things that we've seen in the early 2010s? I mean, if you remember things like cameras in the FOMC, increasing sort of the visibility into the Fed's decision-making. I think that if you see that would be a reason to worry. But for now, I mean, we haven't seen anything in Congress in that regards. And again, a lot of members of Congress, both Republican and Democrat, will try to preserve Fed independence. I don't think there is a majority in Congress to change the status of the Fed or to give the executive branch, a say into monetary policy.
Dan, great to have you on the show today. We covered a lot of ground in a short amount of time. Appreciate it.
Thank you.
The Dow and S&P 500 both notching a fresh record close. Wall Street building on a post-election rally. Yahoo Finance's Josh Schaefer joining us now for the trading day takeaways. Josh.
Yeah, Josh, we got S&P 6,000 today for the first time at the close, but I want to zoom in on some of the other parts of the market that have been rallying since Donald Trump won that election, and really some areas that have been moving the most. So we're looking at FOMO coming back into the market, the investor fear of missing out, right? And an area you often see this is some of the more speculative parts of the market. So let's take a look at Bitcoin here, Josh. You can see Bitcoin rallying above 88,000 for the first time today. I believe it started hitting records at 82,000 and has been subsequently hitting records essentially all day. It's just been moving up to levels it's never seen before. And with that, you've seen crypto stocks rally with it, right? So we're looking at 5-day gains here. Look at the 5-day gain in Coinbase. The stock is up 74%. I mean, it's a crazy... They didn't report earnings, right? This is not exactly why the
I wonder how much
moving.
of that is, what did Trump tell you about SEC Chair Gensler, gone on day one?
Right.
I do wonder, like Robinhood, Coinbase, how
Some
much
of these seem to be, that's a good point, Josh. There's a fundamental story here that certainly could play out and benefit the crypto industry. But is it 74% better for Coinbase? I don't know. Maybe it is, right? Maybe it is. And I think even when you go to some of the bigger stocks, right? We've talked a lot about Elon Musk's relationship with Trump, how that could potentially help Tesla. The stock's up 44%. I mean, we're seeing massive moves here, and you're starting to hear some strategists talk about signs of exuberance in this market, signs that the public is re-engaged with speculation. That was Evercore's Julian Emanuele specifically highlighted the rallies in Tesla and Bitcoin. It's part of the reason they feel like stocks could go higher, but also we're starting to get to that point where you're looking, and sometimes it's hard to just explain some of these moves. They're so massive.
And some of what we were also talking about, we were talking in the newsroom, Josh, about another, you talk FOMO, you can talk retail FOMO, but you can also talk active manager FOMO.
Yeah, so there's an aspect of FOMO that is simply, let's pull up the S&P 500 year to date, right? When we talk about this cash on the sidelines and an active manager and sort of what they're providing for clients, you're essentially saying if the S&P is your benchmark, you can do better than this, right? That is the ultimate thing we're saying here is, okay, if the S&P is going to go up 26%, you're paying me a fee to outperform that. I need to have money in the market. And that's part of the reason why people have been pointing to, say, an area like the Russell 2000. Over the last 5 days since the election, up 9%. Because it's an area that people feel has been undervalued relative to the S&P 500. So you call that a catch-up trade, right? Maybe you can get a catch-up trade in some of these areas that haven't been loved. That's part of the reason why you're also seeing people call for the S&P 500 to just keep moving higher through the end of the year. Essentially, all that cash we've been talking about that's on the sidelines, you got to get it in the market for your clients. So when you go to your clients at the end of the year, you say, you were a part of the rally, right?
You
that's
look
sort
smart,
of one of the...
You look good.
Right, exactly. Our final takeaway, Josh, is what I just mentioned about S&P 500 targets increasing.
More optimism.
A lot more optimism. So you had, I mentioned Julian Emanuele over at Evercore. He says 6,600 for the S&P by June 2025. You guys talked to Ed Yardeni earlier today. Yardeni saying that he sees 7,000 by the end of next year. One thing that stuck out to me, Josh, about Yardeni was some of what he was highlighting about the tax cuts and how that's actually going to impact earnings. It seems like he feels like there's a strong case there with Trump for why stocks go up.
Yeah, and also, listen, he's just very focused on the E, right? Earnings growth. I mean, he's a believer you're going to see that keep trucking higher.
And one thing that stuck out to me from John Stoltzfus this morning over at Oppenheimer, he was highlighting valuations, essentially saying what Yardeni also said in his note, and Evercore's Emanuele also pointed out, Valuations, yes, they're expensive right now, right? So we're looking at the forward 12-month PE ratio for the S&P 500. Relatively expensive. This is well above your average. So you're paying up. Look at how long it can last, though.
Yeah.
And then we're getting cut off here at 2002. But if
It's
you
not a
remember
timing.
back in the
Right.
dot-com bubble, it can stay up there for a while.
Right.
And so you're going to keep, I think, as we get into 2025 and think about this outlook, here a lot of strategists keep pointing that out. The bottom can sometimes be quick, but the top, you don't really know when expensive is too expensive, and you normally need a catalyst. So that's the key question right now a lot of people are looking for. What would be that downside catalyst? Is it sticky inflation? Is there something with the labor market? Keeping your eyes out for things like that, because right now it feels like there's no clear catalyst down.
All right, Joshua, thank you. Appreciate it. Meanwhile, Bitcoin's post-election surge continues. How much further does the cryptocurrency have to run? We're going to discuss that when Asking for a Trend returns. We are tracking what's trending in Bitcoin, the cryptocurrency hitting record highs today on the back of another Trump presidency. Our next guest thinks Bitcoin could hit 100,000 when Trump takes office. Joining us now is Joe McCann, founder, CEO, and CIO of Asymmetric. Joe, it's good to see you. Let's start, Joe, first and foremost, with just the move we're seeing in Bitcoin, Joe. What is driving that? What would you chalk that up to? Is that simply, Joe, it's crypto allies, including Donald Trump winning these elections?
Yeah, I mean, look, there's a number of actual structural market forces at play right now behind the price of Bitcoin. I think first, it's very clear that the Trump administration and their election team outlined a set of very specific policies that they planned on enacting within the first 100 days of him taking office. What was mispriced was a red sweep and certainly taking the popular vote. So a number of folks have been more or less waiting for the election to come behind them to then allocate to Bitcoin or crypto more generally. But given the amount of momentum that the Trump administration has from the crypto industry and its support, you're actually seeing, I think, a lot of buying outside of the United States as well, even though primarily the majority of the buying has been US based. And the reason is the strategic Bitcoin reserve that they've actually floated by, I think Senator Loomis was the first one to bring this to light, which would effectively be looking at buying upwards of 5% of the total supply of Bitcoin. And so I think that that's also affecting the price, because I'm sure other reserve banks around the world are considering adding Bitcoin to their balance sheets as well.
You know, you mentioned, Joe, on the campaign trail, you know, Trump did bring up another number of issues, policies, ideas, you know, encouraging Bitcoin mining, national Bitcoin stockpile. I mean, for you, for an investor, I mean, what would you like to see him concentrate on? What would be the policies you think he should emphasize?
Yeah, I mean, look, I think it's important for the United States to be the leader as it relates to Bitcoin and crypto more generally. Starting with a strategic Bitcoin reserve is an excellent first step. But I think I speak for the entire investor community here that what we really are looking for is clear regulations and clarity around the way that we can actually ensure that America remains the leader in innovation, particularly as it relates to crypto and blockchain. And so our view really is that we'll see hopefully a lot more robustness and a comprehensive regulatory framework laid out for us, which not only enables investors like myself and other fund managers to navigate the space appropriately, but most importantly, the entrepreneurs in the United States that have been leaving the United States to start crypto and Web3 related businesses.
You know, Joe, Trump did promise, I believe he said day one, fire SEC Chair Gensler. One, what do you make of that move? And two, Joe, I'm curious, do you think that move in part explains the kind of moves we're seeing in names like Coinbase, like Robinhood?
Yeah, I mean, I'm not a lawyer, but I'm pretty sure he can't directly fire Gary Gensler. I do think there is a case to be made that he could remove him as chair. And furthermore, I find it unlikely that Gary Gensler would want to remain in the SEC under a Trump administration, given his so clear alignment with someone like Elizabeth Warren and her anti-crypto army. So there's no doubt that a new head of the SEC would be positive for Bitcoin and crypto generally. And I think that this is one of the reasons why you see, you know, whether it's Coinbase, it's Robinhood, et cetera, the publicly traded companies that are already out there involved in the crypto industry benefiting from this sort of forecasted move of a new head of the SEC.
Finally, to circle back, Joe, I want to get your, you mentioned this, this legislation from Senator Loomis, Strategic Bitcoin Reserve, which would, among other things, it would implement a 1 million unit Bitcoin purchase program over a set period of time. You're basically kind of mirroring the size and scope of the gold reserves. Do you have any sense, line of sight, Joe, on whether that actually happens, that legislation becomes law?
Well, I mean, I think that's up to Congress and ultimately the president as well. I do think that there's a non-zero chance that this thing happens, and in fact, a high probability of it. If you look at the other commodities that the United States has historically had strategic reserves for, we're talking about gold and oil. Well, Bitcoin has been clearly labeled as a commodity for a long time. And given the kind of, I think, momentum again behind members of parts of the Republican Party and even some members of the Democratic Party seeing Bitcoin as a truly strategic asset, it just makes a lot of sense for this thing to actually come to light. Now, the question is, how long could that take? And I would argue, and this is just my own speculation here, that the Trump administration is likely going to focus on things like immigration first, as opposed to, say, setting up a strategic Bitcoin reserve. But that's okay, because I think the market is actually anticipating this taking a bit of time. It is Washington, D.C. Things move at a glacial pace. But more importantly, the reason I think people are adding now is because the price of Bitcoin should be significantly higher in the case that there's more kind of language and headlines surrounding the strategic Bitcoin reserve coming to fruition.
Joe, great to have you on the show today. Appreciate your time and insight.
My pleasure.
On the other side of the break, our chart of the day, more Ask for a Trend right on the other side.
Are you a passionate investing bull? Maybe love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Now, for our chart of the day, we're taking a look at company valuations and Yahoo Finance's Julie Hyman joins me now for a closer look. Julie.
Josh, this is something that we talk about all the time, right? The valuations have been climbing and climbing along with stocks, even as earnings have been growing as well. And this was something that was part of our discussion earlier with Ed Yardeni in the discussion that he is now placing a 7,000 target on the S&P 500 for the end of next year, joining the likes of Julian Emanuel, who said we could get to 6,600 just by the end of June. So there's a lot of bullishness out there, but it's come as valuations have started to climb back up to the levels where they were, at least for the mega cap 8, back to levels where they were sort of in the post-pandemic period. Other stuff is also coming up, and really, especially the S&P 500, is at historical high. So the question is this a problem, per se, when it comes to the rally continuing? Yardeni says it's not.
Not only do I think that earnings are going to continue to grow, but I think they're going to grow maybe faster for longer. Without a recession. So again, that means that over time, if the price were to stay here with a high PE, the E would grow and the PE would come down.
And of course, even if the price does continue to go higher for, say, the S&P 500 or some of these other indices, as long as earnings continue to keep pace or even outpace what we're seeing on pricing, then you will not see valuations get too stretched in his view. Now, we also talked to Doug Ramsey over at Luthal Group, and he had a bit of a different spin on it. He says, you know what, maybe the mega caps and the S&P 500 are getting a little too stretched for his taste. He likes more what we're seeing down here, which is the mid caps and the small caps. Like so many investors we've been speaking to, Josh, he thinks there is more room for upside in that particular group right now.
All right, thank you, Julie. Appreciate it. And that is a wrap on today's Asking for a Trend. Tomorrow, tune in starting at 8:30 a.m. Eastern for the 2024 Yahoo Finance Invest Conference.